Welcome to The Explainer. Let's dive right into this. Today, we're unpacking the fascinating and honestly somewhat contradictory first quarter 2026 earnings from Artisan Partners. Now, if you follow the asset management space, you definitely know Artisan. They trade under the ticker APAM, and they are a massive player. But their Q1 results? They present us with a classic tale of two trends. On one hand, we're looking at record-building revenue, but on the other hand, we're seeing billions of dollars literally walking out the door. It's a really complex dynamic, so we're going to break the whole thing down step by step. And that brings us directly to the central paradox we're exploring today. How exactly does a firm grow its revenue by 9% while simultaneously losing $3.1 billion in client cash? To make sense of this, I want you to picture Artisan's business model right now as a leaky bucket. Water's pouring in at the top at a really impressive rate, but there is a sizable hole right at the bottom. To truly grasp the health of this business, we need to investigate both the revenue coming in and the assets leaking out. All right, let's start with the top line, the water pouring in. Artisan's revenue for the first quarter of 2026 hit $303 million. Now, what you should really take away from this is that despite some serious market volatility and broader headwinds, this is a solid 9% year-over-year increase compared to Q1 of 2025. This growth is largely being driven by higher fee-earning asset levels and some really strong contributions from a few of their newer strategies. Now, it's pretty fascinating to see how that top-line revenue cascades down the rest of their income statement. From a purely financial perspective, Artisan Partners is running a highly profitable ship and successfully building on its foundation. Operating income jumped 10% year-over-year to $94.2 million. Adjusted net income rose to $70.8 million. If you only looked at these core metrics, you'd see a business operating with just absolute excellent efficiency. And because they're generating such robust cash flows, they are actively rewarding their shareholders. The board declared a dividend of 77 cents per Class A share for the March 2026 quarter. But hold on, because this isn't your standard fixed dividend, and understanding how it works is absolutely crucial to understanding APAM's overall agility. So the key here is understanding this specific structure. Artisan utilizes what's called a variable quarterly dividend. That basically means they return roughly 80% of the cash generated from operations each quarter directly back to shareholders. Why does this matter? Well, it ties perfectly into management's overall philosophy. By keeping the dividend variable, they aren't locked into some rigid payout during lean times. It keeps their balance sheet incredibly nimble, allowing them to return substantial capital while still keeping their debt leverage ratio super low, just 0.4 times. Okay, before we get to the other side of our leaky bucket analogy, let's just quickly align on a core industry metric, assets under management, or AUM. As a reminder, this is simply the total market value of all the investments the company oversees for its clients. In asset management, AUM is the engine. Bigger engine, higher fees. So let's look under the hood and see what happened to Artisan's engine this quarter. Ouch. This is where we see the leak. Despite those financial metrics looking great earlier, overall client assets actually shrank. They began the quarter with $179.9 billion in AUM and ended it down at $173 billion. The primary culprits here? First, net client cash flows were negative $3.1 billion, meaning clients pulled out significantly more money than they put in. Second, negative investment returns shaved off another $4.57 billion, so the firm is making more money off fees right now, but the total pool of money they are managing is contracting. And this starkly illustrates exactly where that contraction is happening. It's a massive contrast between two very different business segments. On one hand, their traditional equity strategies are facing heavy attrition. But conversely, credit and alternative investments are experiencing really strong fundraising. In fact, their Eamsights Capital Group and credit team raised a combined $1.1 billion in the quarter, and their global unconstrained fund just crossed the $1 billion AUM mark. To really understand the outflow on that equity side, let's look directly at the explanation from CEO Jason Gottlieb. He noted, across the equity strategies, we saw clients de-risking, reallocating after periods of asset class outperformance, and in some cases, shifting to passive alternatives. This is a purely objective look at a broader macro trend. Investors are simply moving assets around, and the entire industry-wide shift toward passive index funds is presenting a very real, very heavy headwind for Artisan's active equity portfolios. Knowing this headwind is out there, how is management patching the bucket? Well, here is Artisan's three-step strategic response to adapt to this evolving landscape. Step 1, maintain a pristine balance sheet. With debt leverage sitting at just 0.4x, they have the dry powder they need to act. Step 2, aggressively expand the platform in the exact areas where they are actually seeing growth, credit and alternatives. And Step 3, execute strategic mergers and acquisitions to buy the capabilities they don't already have built in-house. And the thing is, we can already see this strategy in action. During the first quarter, Artisan officially closed the acquisition of Grandview Property Partners. This is a direct, tangible application of their pivot into alternative assets. It specifically takes them into the realm of private equity real estate. So what does buying Grandview actually do for the balance sheet? Well, it immediately added $880 million to their assets under management in Q1. From an accounting perspective, it generated $39.5 million in goodwill and $8 million in intangible assets. But more importantly for the future, the team has been fully onboarded, and they are laying the groundwork right now to launch a brand new flagship private equity real estate fund later this year. They are literally buying growth to offset their equity outflows. And there is pretty compelling evidence that this strategic pivot is working. Just look at this number, 23%. That is the annualized organic growth rate achieved by the EM Sites Capital Group and credit team combined during the quarter. So while the traditional equity side of the business is facing attrition, their newer credit and alternative teams are growing at a 23% annualized clip. That's serious momentum. Which brings us to the ultimate question moving forward. As Artisan Partners successfully patches its leaky bucket with these high-growth credit and alternative strategies, can that new growth outpace the relentless industry-wide investor flight toward passive investing? I mean, they have the balance sheet, they have the cash flow, and they clearly have the strategy, but watching the race between their equity outflows and their alternative inflows is what makes this such a fascinating company to track right now. Thanks so much for joining me on this explainer, and definitely keep your eye on how these two trends play out in the quarters to come.